welcome everybody to the webinar with FD Works. We've got Simon Williams today joining us to talk about making tax digital and everything else that's super confusing about accounting for startups and the things that we probably all do wrong, but we don't know we do wrong and it's costing us money. So welcome, Simon. Tell us a little bit more about you and FD Works in a nutshell.
Hello. Yeah, thanks, Ash. So my name's Simon Williams. I am a business partner at FD Works. So FD Works, we're an accountancy-based company based in Bristol and Bath, but we work with companies across the UK, and we specialise in working with startups and scale-ups and trying to help them grow. So yeah, our team consists of some bookkeepers, some business planners, and some accountants. So yeah, we're kind of here to help people out who are starting out, and also help them scale when they get to that point. So we'll be really brief today, but just kind of quickly touch on making tax digital. So that's me. I've introduced myself. Hi, that's me. I used to work in a big accounting company. I've gone to the small people, which is great. It's really fun. So making tax digital. What is making tax digital? So basically, if you are a company that has annual turnover of over £85,000, you have to start to submit your VAT returns via with the kind of detail behind it. So if you've ever done this before in the past, there's a portal on HMRC where you type in some numbers and you click go. From now on, you won't be able to do that. You'll have to also submit the evidence behind the numbers. So that means that generally the best way to kind of get around that is to sign up to a cloud accounting software. As a practice, we use Xero. It is pretty good. It's good for small businesses, and it does a lot of the annoying things that you probably don't have time to do, and make sure you're compliant. If you don't want to use something like Xero, and if you are above the VAT threshold, you can use some bridging softwares which kind of take Excel sheets and they put it into a certain format which links to HMRC, and you can submit them. But if I'm completely honest, it's probably easier to use a cloud accounting software package. Just why they're doing it so that there's like a £7 billion gap from tax that's not paid in the UK from businesses, and they think that by getting some of the data behind the transactions, they'll be able to start reclaiming some of that difference. So they're doing it so that that people can be more efficient, and also so they can work out what is going on. So what does that actually mean? So the 1st of April, so all transactions after that date, if you're VAT registered, you have to submit via this system. What it actually means in practice is you have to set up a new login, which is through the government gateway on HMRC. So if you go to HMRC and type in making tax digital VAT, you'll go to a page with a login, and you'll be able to request a new number. That new number will be your access into the site, and then you can use the cloud accounting software with that new login to get into there. So if your business generally businesses are on quarterly VAT periods. So say my VAT period was from the 1st of April to the 30th of May, June, 3 months, April, May, June. So if that's your first VAT period, that'll be the first submission you need to make. So in terms of what you need to do now, everything that happens from the 1st of April onwards, from a transaction point of view, you either need to be on a cloud accounting software or be aware that that information will need to be submitted for HMRC. And the information behind that needs to be correct. So for example, if you are buying something from Amazon and it is VATable, you need to be coding that as 20% VAT, or if it's not VATable, you need to be coding that as zero rated. So that is all kind of done generally in the cloud accounting software. So that is making tax digital.
Jump in there quickly and just say, obviously, around the accounting software services, there are obviously lots of them available, but Xero is the one you guys obviously are partnered with and recommend. If anybody is looking for high levels accounting support, obviously they can use you. They can't find Xero in our toolbox. Toolbox is obviously home to a bunch of incredible offers for startups, but the only reason they can't find Xero in our toolbox is because there's actually a publicly available deal for startups that lots of people don't know about. They can get a better deal if they do it through you guys and you become their accountant, which you're ours, and I wholly recommend because it's been incredible. But there is a 6 months 50% off of Xero that may not be valid at the time of viewing this, but that's, I think, available now, and people could just Google Zero for startups and that should come up. But yeah, sorry, I jumped in. I just thought it was worth saying at this point. So yeah.
No, definitely. And there are other ones like, and if you're very early stages, something like Free Agent might be good as well because it's a little bit simpler. So that will also have the capabilities to do VAT returns if you need to do them. If you are VAT registered and you have below 85 grand turnover, you don't have to sign up to MTD, Making Tax Digital, until 2020. But if you do sign up, you can't not sign up. So once you jump into it, you have to do it going forward. So that's just a little nuance.
Great advice, though, because some people will just jump straight into it. But yeah, sorry, continue.
It's a little stat. So 50% of businesses aren't ready. So if you're not ready, don't worry. You're in the majority, but you need to be ready soon. So if there's any questions or anything like that, give us a shout. And as Ash mentioned, we're brand partners of Yena, and we love working with Ash and his community. And we'll hopefully in the not too distant future have a series of more content which kind of will help you navigate finances and accountancy from a startup perspective. I won't touch on much of that today, but that's something to watch out for in the future.
Lots to come for sure. Whilst we still got you, Simon, there are two questions that actually our community asked that we were hoping to answer today live, but a couple of teething problems with Zoom, of course. So I thought I'd ask them, and then they can be answered in this video for these people that have already asked. So
sure.
The first one was around, and these are slightly separate, so short and sweet answers will be good, and we can kind of cover these in later content. But how directors' pay works, how much is the best tax and national insurance implications, and dividends. Obviously, quite an open-ended question. I imagine you could go on about it for quite a while, but I suppose most people are thinking about the most tax-efficient way to pay themselves as a director. Really.
Yeah. So directors' pay is but basically, director's pay is an amount that you can pay yourself, which is below the thresholds for national insurance and below the thresholds for PAYE. So basically, what it means is it's an amount you can take out of the business as a salary every month, and you have to pay no tax on it. So quite often, what a lot of directors do is they take out that amount as a salary every month. I double check what it is, but I think it's £702 a month. So it's around £8,000 a year. But if in the UK, obviously, yeah, if you Google it, you'll find out. But it's around that value, and the reason it is at that value is because you pay no tax whatsoever on that value. Then on top of that, quite often what some people do is then the rest of it they take as dividends, depending on the state of their business. The reason for that is the dividend, the basic rate for dividends, which is the amount you can earn up to £35,000, I think, is 45. But I need to refresh my memory. Is at a lower rate than if you're paying yourself through for a salary. So it can be a more tax efficient way of doing that. But then there's lots of other things to consider in that. So it might not be as straightforward. For example, if you're a company who does a lot of research and development and want to claim back R&D, you can't claim back R&D on dividends. You can only claim it back on salary. So it's probably a question of what process you're doing and what you're doing. So it's a really straightforward answer. There's an amount which is, I think in this tax year it's 102, but it's going to change a little bit in 1920 tax year, which is from April onwards. But it will be around that ballpark. And if you pay yourself that amount for your salary, there'll be no tax whatsoever. Then what you do with the rest of the money, if you're lucky enough to be able to declare dividends, is kind of depending on the situation of your company.
Right. No, really, really great advice. And you lightly touched on R&D tax credits there, which we won't delve into today because it's probably a whole can of worms in itself. But it's a great way for people that have worked on mostly technical products to claim back money for the time and cash that they've spent on building those things. We'll probably cover that in a later session with you guys and the likes of Forrest Brown, for example, to be able to give people more information on that. But I know a number of members have claimed back between tens and hundreds of thousands of pounds worth of R&D tax credits, so it's certainly worth looking into. We're looking into ourselves at the moment. Final question before we wrap up, which was around how you can track, and this is actually a really good segue into this question based on what we were just chatting about. So how you can track dividends in Zero, and how does this impact the bottom line?
So Zero is not the best at tracking dividends. So the way that generally this will work is, as a company, you should declare dividends at a periodic basis throughout the year. So if you looked at a large public company, you might hear stuff saying they have interim dividends and they have final dividends. Basically, what that means is they pay out dividends generally every quarter. So they will look at how much money they've made, and then they'll say, right, we think we can pay out this amount of money every quarter. So in Zero, generally what you do is, if you're paying yourself a salary, that's fine. That'll go straight to your profit and loss account. But dividends, if you've taken money out of the business, but you haven't declared a dividend. So, for example, if I had a business, I'd pay myself a director's salary, which might be £702 a month, but actually I take an additional £1,000 out of the business every month because I need to pay my bills or whatever it might be. So that is deemed as a drawing, is what it's deemed as. So basically, you're borrowing money off the business. So what happens in that sense is that becomes a liability. It becomes the business. You owe the business money, which goes onto your balance sheet. Sorry if I'm losing people, but so generally what happens at that point in time is, when you declare a dividend, is you say, actually the business owes me money because even though I've taken money from off the business, I'm now going to declare a dividend. And what you do is you say, I don't actually owe the business that money is dividend, and you push that through Zero as a adjustment between your director's loan account as one side of it, and the other side of it will be a dividend account code. And generally in Zero, that dividend account code will be in your profit and loss as an expense, but it should be below your net profit line, because your dividend is after net profit. Really simple, well, not that simplistic, but trying to explain it as simple as possible.
No, I think that was really comprehensive in the short amount of time that we've got. Actually, the good news is that question came from Ryan Vaughan from Lightbulb, who I know is actually one of your clients. So he's lucky enough to ask you those questions anyway. And obviously, good testament to the fact that members are starting to use you guys, because frankly they should. I'm not just saying this because you're brand partners. We always say this about our brand partners. The reason our brand partners are our partners is because we would use them and we think they're brilliant anyway, not just because there's a partnership in place. That's why there's a partnership in place. So yeah, frankly, I think, as I said to you before, and it's a soundbite I think you're going to take away, is that the accounting meetings that I've had with you guys are the first time I've been excited about my accounts. So it's obviously a really powerful thing. But the insight you've given today has been really, really helpful. Making tax digital is a bit of an unknown quantity to most of us, unless you are qualified like you are. So this video will hopefully help the whole community. If they have any further questions, obviously we can definitely put them in touch with you and get those questions answered, I'm sure. And yeah, in that case, where can they find you and more information on FDWorks?
Yeah, so if you just Google FDWorks or fd-works.co.uk, it's really the best place to find us, and then you can our numbers on there if you want to give us a call, or there's a email address to support@fdworks.co.uk if you want to just drop us a line, and then we can go from there.
It's worth saying that you guys obviously specialize in working with scaling and high growth startups. So if you're a tiny company and looking to remain that, or possibly going to remain that for a little while, then FDWorks maybe slightly be above and beyond the capability and the price range for you. But there are people within the community that can help with that. However, if you are looking to grow a company and scale that revenue over the next year to 2 to 3 years, then they'll definitely be the perfect people for you. But they're as great humans anyway, and will help wherever they can. So yeah, huge thank you to you today, Simon, for squeezing us.
Thanks very much, Ash.
And giving that advice. And we'll catch up with more content very soon. But thanks everybody for tuning in. And we'll hope to get this as an actual live session very soon too. But cool. Cheers, Simon, and have a great day.
Cool. Thanks, Ash. Cheers.